So Genesis is an integrated energy company within the market of New Zealand. We retail three fuels: electricity, gas, and bottled gas, or LPG. We generate electricity, and we also have a joint venture for upstream oil and gas off the coast of North Island. So there's a number of different listed energy companies in New Zealand. We're the largest retailer of electricity. We've got the largest residential customer base. We're also quite different in the sense that we not only sell electricity, which many of them do, but we also focus on gas, as I've mentioned, and LPG bottled gas. The three or four things that we talk about that differentiate us is in our generation portfolio, which is a key component and probably the largest part of our P&L. We have hydro systems both in the South Island and the North Island of New Zealand, and we also have a mixture of hydro and thermal. New Zealand's a very renewable market, so what differentiates us there is our ability to create value in volatile market conditions when the water is fluctuating up and down. We also have a very interesting retail business where we've got a customer IT platform that's very flexible, so we've invested in that over the last few years, and that's giving us the opportunity to integrate the different fuels we offer for customers into seamless customer experiences. And then our Kupe joint venture is also really important because we use a lot of gas when we're running a lot of thermal plant to generate electricity, and so we determine the production of Kupe oil, gas, and LPG based on how much gas we're using. So that gives us a differentiation as well. And then ultimately we talk about our culture as well. We've got a very agile culture. We like to see ourselves as more of a startup than an incumbent in the industry. And we focused a lot over the last few years in hiring people and in building our culture around agile technologies and capabilities. So we're a high yield business. We're probably in the top decile, both in New Zealand, Australia, and also in the UK against the FTSE 100. Our yield last year was about 6.9% after tax, or net yield. So that's really important to us, but we also talk to investors about being yield plus growth, because we look ahead to the early 2020s and there's some opportunities to grow our business, both organically but also systemically within the business, as we have some old gas contracts that roll off that today we're paying very high gas prices. In the early 2020s, our gas prices will come down. So we've got a growth target to hit $400 million of EBITDAF, as we call it, by FY21, and we're well on journey to do that. So we have a sustainability framework and policy. At the end of the day, we can't control that we sometimes have to emit carbon as we run our thermal plant, even though about 60% of our generation is renewable from renewable sources. But we have a sustainability framework which actually encourages us to be net carbon across the rest of the business. We also have a policy to increase the use of EVs in our portfolio, so all our light vehicles will be electric vehicles by 2020, and we're going to move our heavy vehicle fleet to be half electric vehicles by 2025. And then we've also invested a lot in diversity. We've got a very diverse workforce. We're focused on inclusion programs, and we do a number of things within the environment within New Zealand as well. So that framework outlines everything we do, and it's available on our website. So as I mentioned, our target is to hit $400 million of EBITDAF by FY21. When you look into the early 2020s and our gas supply agreements start to roll off, our earnings will have a nice tailwind to them as well. So our dividend policy, which is currently a high yield, our dividend policy commits us to increasing dividends in real terms over time. As we move into the 2020s, that'll give us a great opportunity to continue to increase the dividend yield.